Hi, I'm Brian Rezny with Rezny Wealth Management, and today I want to share why I see a Goldilocks scenario shaping up for the economy, a sweet spot for investors. This week, stocks took a breather after a record run. As Fed Chair Jerome Powell reminded us, the Fed's path isn't set in stone. He emphasized data dependency, noting upside risk to inflation and downside risk to the labor market. No risk-free path, he said, but I'm not worried about the market's pause. It looks like healthy profit-taking, not a shift in the outlook. Here's why I'm optimistic. The latest S&P Global Flash PMI report. It shows business activity slowed slightly, dropping from 54.6 in August to 53.6 in September. That's still solidly in expansion territory, above the 50 line that separates growth from contraction. A softer pace suggests the labor market is cooling, with the employment sub-index hitting a 5-month low. That keeps the Fed in easing mode, even if they skip a rate cut in October. Here's the kicker. While producer input costs rose to a 4-month high, consumer price inflation cooled to its lowest since April. Goods inflation, in particular, hit a January low. This tells me businesses are absorbing tariff costs, not passing them on to you and me. That's great for keeping consumer prices in check, even if it squeezes corporate margins a bit. A cooling labor market and moderate consumer prices, that's the Goldilocks scenario we want. Growth that's not too hot, not too cold. It supports sustained economic expansion and a favorable environment for investors. The Fed can keep easing policy over the next year, aiming for a neutral rate. The S&P Global PMI is just one report, but it's been a reliable pulse on the economy since the pandemic, and it's one I watch closely. At Rezny Wealth Management, we're keeping our eyes on these trends to help you navigate this market. Want to dive deeper? Visit us at our website or reach out directly. I'm Brian Rezny, and I'll see you next time.